Hello, friends. It's John Lone King, and here I am back with my third episode of my new podcast, From Profits to Properties, where I help business owners grow their profits by teaching you business tactics every single week that'll help you to enhance your sales and enhance your profitability. And then we talk about a tactic related to mortgages and growing your real estate, taking those profits that you've made and turning it into long-term wealth building through real estate of buying a primary home, a luxury primary home, or getting a portfolio of investment properties that'll help you grow your long-term wealth. So today we're going to cover one topic in each category. The first category is the business topic, and it is going to be on the topic of go for no. We are taught all too often in our business to focus on yes. Your goal is to get to yes, to get the client to say yes. I'm going to give you a concept today that is going to turn that on its side, and it's actually going to talk to you about why you should focus on no as being the outcome, because no is actually the best place to go to get the yes you're looking for. Then the second thing we're going to talk about is the biggest mistake that business owners make when trying to qualify for a mortgage. And it has to do with paying too much money to Uncle Sam as a trade-off to get yourself a mortgage. I'm going to give you information about that mistake and some information about how you can make sure that you avoid that mistake going forward. So here we go with our first topic, which is go for no. Now, first of all, you're probably thinking, John, you're on crack. Like, go for no. Why would I want to focus on no? Well, in our business, I want to remind you, I firmly believe every single business owner, every entrepreneur is a salesperson. Now, obviously, if you're in a sales position, then clearly you know you're a salesman. If you are not in a sales position and you think, no, I'm the owner, I'm the CEO, I'm the president, you are in sales. Whether you are selling your business directly to the end user, whether you're selling yourself to investors, whether you're selling your concept and the next strategy to your team and your staff to keep them moving forward, you are in sales. And so every tactic when I talk about sales, I don't want you to tune out and say, that doesn't apply to me. It absolutely applies to you. And here's what Go for No is. It's a book. So first of all, the book Go for No, I got the author's name right here. It's called Go for No. Yes is the destination. No is how you get there. And it is from Richard Fenton and Andrea somebody. I can't read it. I need my glasses. Anyway, so Go for No. If you want to read the book, it's a parable. I'm going to give you the basics of what you need. Go for No really focuses on the fact that we all try hard to get a yes from our clients. And we might say, especially if you're in sales, hey, my goal is to make X number of calls in order to get X number of yeses. But this is a numbers game that is better accomplished by focusing on the no. So the parable starts with a person who bumped his head and ends up in a parallel life, parallel universe where he meets himself in this other universe. And the person that he meets that is him is way better off. And he ends up talking to the guy and saying, wait a second, you live in this mansion and you have all this money and you've built all this wealth, and yet we're the same person. And they talk about childhood memories and they're exactly the same. And they figured out where their life changed. And their life changed one day when they were working in a suit store, like a Men's Warehouse or a Nordstrom's, selling suits. And that is the moment, that day, that diverged everything after that changed. And here's the simple story of what happened. They were super proud of a sale they just made, largest sale they ever made, and they sold everything they could to somebody, and they were super proud, and they went back to their district manager who was on site and said, hey, I just made my biggest sale ever, and the district manager wasn't proud. Instead, he said, how did you know that the buyer was done? And he goes, what do you mean he was done? I sold him a suit, I sold him a tie, I sold him a shirt, I sold him shoes, I even sold him socks and a belt. What else is there to sell him? And he says, how about another suit? And he paused for a second. He goes, well, but he bought one. He goes, how do you know he didn't need a gray suit instead of a black one, or in addition to the black one? What about a second pair of shoes? What about brown shoes instead of just the black shoes? What about a second tie or a third tie and a second shirt or a third shirt? How do you know he was done? And the version of him that became successful understood that and latched onto it and said, oh, so I need to keep offering more until they say no, thank you. The version of him that wasn't successful stopped and said, no, when somebody's, I don't want to be pushy. I'm not going to ask for more from somebody than what they've agreed to. And that made the difference between the successful version of him and the not so successful version of him. Now, there's a lot more to it, and there's a lot more tactics within the book, but I want to stick with that one to simply give you this concept that you need to keep asking without being pushy. So a good example is I am in the mortgage world, and so I work on referrals. I ask my past clients, I ask my business partners, hey, do you know, I've got a brand new program that just came out, and I'd love to know if you have any of your sphere, anybody you know that would be a good fit for this program. And a typical salesperson, first of all, would be afraid to even say that. And so an advanced salesperson is reaching out and saying, hey, can you think of anyone who fits this criteria, who could use this service, who could use this product that I've just talked to you about? And they say, oh my gosh, yeah. You know what? I had a client just yesterday who could use that exact service, and he's in that situation. And we are so thankful as the salesperson. My gosh, it worked. It worked. We actually got a lead from asking that question. And we're so elated. We're so happy that we hang up the phone. If we're smart, we got the phone number and the name of the lead, and we're able to call them. And if you're really smart, you got the person referring them to you to agree to send a group text introducing you to each other. That's an advanced strategy that says, hey, I really would love the opportunity to connect with that person because you said we might be a good fit. You said they might be a good investor for me. You said they might be a good opportunity for me to help them with that program that I just talked to you about. Would you mind sending them a group text introducing me and telling them why you think we should connect? Now it's a warm introduction instead of a cold connection. Yeah, it's warm because you were referred by Bob, but it's even warmer if Bob sets you up by sending a group text. Okay. But even once you do that, it's really simple to say, thank you so much, Bob. I really appreciate that. Is there anyone else you can think of that would benefit from this program? And Bob's either going to say yes or Bob's going to say no. Don't overcomplicate it. It's not more challenging than that. And if Bob gives you a second person, you're like, oh my God, that's great. Nobody's ever given me two people. Bob must be done. Thanks, Bob. Talk to you later. No, you missed an opportunity to simply say, thank you so much, Bob. Would you mind group texting with that second person as well? Beautiful. I really appreciate it. By the way, before I let you go, does anybody else come to mind that I could help with this program? Matter of fact, John, there's a third person. Great. Give me their information. Let's set up the group text. Bob, before I let you go, is there anybody else that you could think of? No, John, that's it. Beautiful, Bob. I really appreciate you. I appreciate your trust, and I appreciate you connecting me with these people. I'll be looking for those 3 group texts, and I hope you have a wonderful day. That's as simple as it is. It's as simple as you keep asking until they say no. If they say no right from the beginning, no big deal. But imagine if you simply called 10 people and 3 of them said, yeah, I got somebody for you, and you stopped right there. Great, you got 30% conversion. But the fact is that those 3 people might know more than one person. You already have proof they believe in you, they believe in your product, and they trust you enough to refer you or to do business with you. And so if you're selling directly to them, say, hey, you already trust me, you already believe in me. Do you want to do more business together? Or if they're referring somebody to me, hey, you already trust me to refer, which is actually harder for somebody to refer than it is for them to do business with you directly, but I'll cover that topic later. The fact is you have somebody that is primed, willing, and able and ready to do business with you or to refer business to you. Don't squander that opportunity. Those 3 out of 10 people that say yes, you could probably get 6 or 7 actual opportunities out of that. You made 10 phone calls, 5 people answered the phone, 3 said yes, and out of those 3, you might have gotten 1.5 or 2 actual leads out of it. You don't know how much money you left on the table unless you go for no. The secret to getting the yeses that you want is to go for no. There's a lot packed into this little book. I strongly recommend that you get it because it's an easy read and there's a lot of good tactics in there. So guys, I really appreciate you listening to this first segment. Stick around. There'll be a short commercial right now, and then I'm going to come back and I'm going to talk to you about the mistake that business owners make when it comes to qualifying for a mortgage and how I can help you to make sure not to make that mistake. So make sure to come back right after this brief commercial. Hey everybody, I wanted to take a quick time out from our show to remind you about my Rent Qualifier Loan. If you are looking to build your real estate portfolio and you have gone through the process before buying rental properties, you know it's a tedious process of looking at everything and that isn't required anymore. Check out my Rent Qualifier Loan, where we simplify the process and you get similar interest rates with a lot more flexibility simply by looking at the rental income of the property you're buying or refinancing compared to the mortgage payment. So for more information, reach out to us by calling us at 85 Loan King. That's 855-626-5464, or go to 85loanking.com/RQ. All right, guys, welcome back to the second half of the episode. So hopefully you enjoyed that first half, and let's dive into the wealth building topic. So a lot of business owners are frustrated when it comes to qualifying for a mortgage. And the frustration comes from the fact that you have employees, people that work for you, that make less money than you do, and they have an easier time qualifying for a mortgage. How can that be? You're the one that's putting in all of the hard work. You're the one that's taking all of the risk. They're just showing up and getting a paycheck, and they have an easier time getting a mortgage than you do. Well, yeah, that's the truth. Because of how the federal government looks at qualifying you for a mortgage. Fannie Mae, Freddie Mac, FHA, VA, they require me to look at your tax returns. And they say, look, if you're not paying us taxes on that income, we're not going to let you use that income as part of your qualification for a mortgage. Because guess what? They kind of oversee both sides. They oversee the IRS and they oversee Fannie Mae and Freddie Mac and FHA and VA. And they say, hey, you can't win with one, the IRS, and also win with the other. We're not going to let you double dip into both categories. And so their mandate is that we're looking at your profitability, not your revenue, not what you're really earning, that you're really keeping after expenses, but what you show the IRS. Well, the problem is that most of us have good CPAs, and a good CPA is going to help you find legal loopholes, legal opportunities to reduce the amount of your taxable income. And then comes the day you want to buy a home or refinance a home. And you're going to do what everybody's done for years and years and years, which is you don't take advantage of those loopholes. You say, hey, Mr. Tax Preparer. Hey, Mr. Enrolled Agent. Hey, Mr. CPA. I don't want to have low profit this year because I'm trying to buy a house. And historically, it's gotten worse because people always thought, well, I got to have 2 years of good profit. And so if I'm going to buy a house 2 years from now, I need to start showing good profit this year and next year. And you end up paying a lot more in taxes for those 2 years than you otherwise would have paid. And then you end up taking out that mortgage, you get qualified for the mortgage, and then you end up refinancing 2, 3, 4, 5 years later as interest rates fluctuate, as you need to pull cash out, and you repeat the same mistake of showing more profit on your tax returns because, well, that's the only way for me to be able to qualify for a mortgage, John, so I have to. And now you end up spending more of your down payment money, more of your money that you had in savings that you could have used to pay off credit card debt, and you use that to pay your tax bill to the IRS. Worse yet, you don't have the money to pay the tax bill, and now you have a higher payment obligation to the IRS that we have to count as the mortgage company. So you're creating a deeper hole because you had to add more income and more profit in order to qualify. But now you have more debt, which means you have to add more profit in order to qualify for the more debt. You can see this is a vicious, vicious cycle. So stop the insanity. Going back to, I don't know who said that, but anyway, years and years ago, stop the insanity. Okay, so stop the insanity. Let's look at some alternative methods to prove your income. And the number one method that I want to talk about today is bank statements. Now, bank statements don't work for everybody. But bank statements give you a significant amount of flexibility when it comes to how you qualify. And let me oversimplify how bank statements work. We simply look at the revenue generated and deposited into your business bank account. Now, if you have a personal bank account that you use for business, that's okay too. But we look at one bank account and we say, how much money have you deposited that was business deposits over the last 12 months? Okay, so that is considered your revenue. And then we have to figure out, well, how much are your expenses? Because what's left over is your profit. We automatically presume half of your deposits are expenses, and therefore half of your deposits are profit. Now, some businesses run a much, much higher profit margin. Some businesses run a service business that's just run by yourself. You might run 80 or 90% profit margin. And so this is going to underrepresent your income. So this might not be the right solution for you. It might be, it might not be. But for businesses who have high expense margins, car sales, somebody who's in car sales, you sell a $20,000 used car. you're making way less than 10 grand in profit. Like you might have bought that used car for 16 or 17 grand and you sold it for 20. Like that's the margins if you're lucky. And then you have your other expenses when it comes to the cost of rent and the cost of staff and all that stuff. But if you own a car sales lot and you sell 2 cars a month at 20 grand a piece on average, you have $40,000 of deposits. I get to assume only 20,000 of that is expenses and the other 20 grand is your profit, which means you qualify at $20,000 a month in income. And we qualify you using half of that number can be spent of your profit can be spent towards your house payment, your credit cards, your car payments, which means you would qualify for a $10,000 mortgage payment. And you're like, John, are you on crack? I don't make enough to qualify for that. Well, the truth is then you can qualify for anything you are comfortable buying. Now, here's a couple of caveats. The rate's a little bit higher. Sometimes it's a quarter, sometimes it's a half, sometimes it's 0.75% higher. But that higher interest is tax deductible. So your choice is pay a lot more in taxes to the IRS or pay a little bit more in interest, and that becomes a deduction to the IRS, and you actually win even more. Secondly, your loan to value, you have to put a bigger down payment. Typically, we need at least 10% down on these programs. So if you're looking at a small down payment, hey, I want to go VA with 0 down or FHA with 3.5% down, or I want to use some type of down payment assistance program. Well, this doesn't play ball with those. But if you've got at least 10% down and good credit, you qualify using your deposits. I've had clients, I had a client who was a cement contractor. He laid flat work, cement work, and his profit margin was pretty low because he had a high cost of goods, high cost of the cement that he had to buy. But every dollar that he received in income, including the money he received to pay for the cement, I got to count as revenue, and 50 cents of that I got to count as profit. So I don't want to, for a lot of you, this makes perfect sense. For some of you, this went over your head. I apologize for that. But what I want you to understand is do not make the mistake again of filing your taxes with significantly higher profit just to qualify for a mortgage. Because here's the dirty secret. You're going to refinance again down the road and you're going to have to do it again and show yourself even more profit. So who cares if you pay a little bit higher interest rate for now, especially in the market we're in right now where long-term we expect interest rates to be lower than where they are. I'm recording this in spring of 2025. We expect interest rates to be heading down compared to where they are right now. We just don't know how soon. So when you think about it, you're better off paying a little bit higher interest rate today and then refinancing that later. It really isn't going to cost you that much money. It's going to save you a significant amount of money in taxes. And here's the best part. It might save you from an audit. Because hey, I got $100,000 in revenue, and 1 year that equals 10,000 in profit, and the next year it equals 80,000 in profit, and you keep going back and forth, at some point that's going to flag you for an audit with the IRS. Because they're going to say, hey, wait, I don't get it. You continue to have $100,000 in gross revenue, but some years you have $20,000 in expenses, and some years you have $80,000 in expenses. That's a pretty big red flag for an audit. You want to maintain consistency from year over year. And so if you keep playing with the numbers and excluding and re-including certain write-offs, you're going to end up creating a red flag for the IRS. And that is the last thing that you want to do. So don't make that mistake. Guys, thank you for listening. Hope you've enjoyed this episode. Please do me a favor, share the episode if you've enjoyed this. I'd love to see you put a review on whatever platform you're listening to. Thank you so much for subscribing, and share it with anybody that you know. And I'm looking forward to seeing you next week on From Profits to Properties.